Hi, this is the Philosophical Angle, and I am your host, Chris Angle. And with me is my co-host, Rick Samuelson. Rick is from the West Coast. He graduated from Yale and is a venture capitalist. Good to see you, Rick.
Thank you. Good to see you.
Each month, the Philosophical Angle has a special edition that explores the direction of the stock market and the condition of the economy. So this is our monthly edition, and let's proceed. We use it as a basis of our consideration here, a report that I put us out called the Rite Report. And so let's bring that up to take a look at and see what it looks like, what the economy looks like in January here in 2016. So we start on the beginning of the Rite Report. Takes a summary of all the positive and negative corporate headlines, and this month we probably have got, let's see, we totaled about 24 snippets of negative corporate headlines, such as DuPont to cut 1,700 jobs in Delaware, EMC to cut jobs next year, Shell lowers 2016 capital spending plan, and such. And then we go to the positive U.S., actually worldwide, Wall Street Journal corporate news snippets. And the month gave us a total of only 20. So then we totaled this up, and if you look here in the past, in 2014, generally the positive outweighed the negative. In 2015, most of that is the same. However, in January, it reversed, and we had 45% positive and only 55% negative. So it's kind of a bias toward the negative side. And in the political and economic events, we also total those up, negative and positive. The negative, and as these are fairly important, I'm going to read read several of these. Truck orders plunged. Signs of easing for Manhattan apartments. Canadian household debt is going up. The New York Fed, business conditions declined for the fourth straight month. That's for the state of New York. U.S. industrial production is down 0.6% in November. This is key. This particular indicator has shown to be able to forecast recessions throughout the last 100 years if 5 or more, or if it goes above, closes in on 5%, a decline. And corporate profits decreased 33 billion in the third quarter. U.S. existing home sales plunged, and GDP was revised lower. Other headlines: truck freight demand slides, and the British economy internationally expanded 0.4%. That probably should be in the positive. Here it is. Annualized growth was reduced from 1.8 to from 1.9 to 1.8. That's probably got into the negative side. Also, Japan industrial production fell 1%. On the positive side, there were much more than 11, so the positive side is going to outweigh. We had 31 positive snippets, and so let's go over briefly and see what they entail. German manufacturing report: rise in exports to Europe and to U.S. There's growth in U.S. healthcare spending. Productivity increased 2.2%, And U.S. remains #1 choice for foreign investment. U.S. employers added 211,000 jobs in November. Average hourly earnings advanced 2.3%. And the participation rate, this is a labor rate, the share of working age Americans who have jobs or are actively looking for work clicked up 0.1%. Job growth was solid in industries tied to domestic economy. The construction industry led last month's job creation, adding 46,000 jobs. Retailers add 31,000. Belgium economy seen expanding. And the central bank said the economy will grow by 1.4% this year. Transportation hiring rebounded in November. And Deloitte 2015 holiday survey, consumers upbeat amid retail disruption. U.S. sales rose 0.2%. U.S. consumer sentiment ticked up higher. Consumer data supports a December rate rise. China industrial production gears up in November and increased 6.2%. Japanese business confidence holds up in the fourth quarter. Eurozone industry rebounds in October. Real average hourly earnings increased 0.1%. India lowers economic growth forecast, but it's in the positive because the growth rate is so high, 7 to 7.5 predicted for this fiscal year. Eurozone consumers shrug off security concerns, and sentiment was upbeat. And the U.S. Bureau of Economic Analysis noted that real gross domestic product increased at an annual rate of 2%. Underlying domestic demand appears steady as a broader measure of economic output highlighted by Fed Chairwoman Janet Yellen earlier this month and updated in Tuesday's GDP report suggests the U.S. economy is doing better than broader measures of output suggested. Okay, so and that was advanced 3.2% in the third quarter. Business investment revised higher, and inventory a slightly bigger drag. What the important thing here is that Tuesday's report showed companies let their stockpiles dwindle more than previously estimated. That shaved 0.71% points off the 2% growth rate from July to September. But it means businesses have likely had to place new orders in recent months, which could boost fourth quarter GDP. Canadian retail sales edged up, and the BEA issued a report saying personal income increased by 0.3%. And commercial properties firms set for more deals in 2016, and China manufacturing picked up. And the total of those was 31, and we had plenty of merger and acquisition snippets at 31, which is pretty high historically. So we're looking here as the positive column, the negative column, and predominantly this year has been pretty much positive news outweighing the negative news. If we go over to the indicators, I used 23 indicators. The GDP was up 2%. Unemployment overall is positive. The unemployment rate is down to 5%. The civilian force participation rate ticked up to 62.5. The employment population ratio, as determined by the Bureau of Labor of the BLS, and was neutral at 59.3. And but the employment trends index put out by the conference board gap downwards, so that's a negative. The industrial production output, that's what we talked about previously, which is key. That was down. That took a downtick. And the purchasing managers index contracted slightly. The retail sales is up, so that's positive. Consumer spending is up, positive. Personal income, positive. Consumer confidence, as determined by the conference board, went positive, as did housing starts, up 11%, positive. Existing home sales, down 10.5%, okay, negative. Although it indicates here overall it's in an uptrend. New residential sales are positive 4.3%. Manufacturing trade inventories and sales looks like neutral, no change there. Manufacturers shipment, as put out by the Census Bureau, is up 1.5% positive. Advanced durable goods unchanged. Construction spending up, and the quarterly financial report is positive. And profits from current production, though, decreased 33 billion in the third quarter, so that's negative. The conference board leading economic indicators, though, are positive, and their coincident economic index is positive also. And the conference board measure of CEO confidence, though, is down. High yield bonds are down. We use that as a indicator. And sideways is a neutral indicator in that the iShares select dividend as the uptrend was broken and now it's going sideways, so we'll call that a neutral. Kind of a interesting index that we use here also is the Restaurant Performance Index, which shows that the restaurant industry is expanding, and so we have it a positive. So we have 14 positive, 6 negative, and 3 neutral indicators overall. So overall, Rite Report indicates that that stocks are a hold at least, or and that investors should stay long. So enough going over this report. Let's see what Rick has to say. Rick, what do you think of the economy and the stock market in general presently?
Okay, well, if you went back to the beginning of 2015, if you look at the balance of indicators going forward, you would have much more confidently predicted that there would have been a broad-based gain over the course of the year. And certainly the U.S. stock market, let's leave the rest of the world aside for the moment, because there are particular problems in most of the rest of the world, particularly emerging markets, which are in many areas in crisis, actually. But focusing on the United States, and I think the consensus among the investment banks was you would get, something like a 10% return. Of course, in the event, that was absolutely wrong. The only return you got in 2015 was basically from dividends. The stock market was flat over the course of the year. So, going into this year, where the indicators are all much more neutral, it's hard for me to imagine that, given where valuations stand in the U.S. stock market, which are high historically, depending on how you measure it, whether you use standard P ratio for the S&P or any of the other enterprise value over EBITDA. But by any of those measures, the valuation of the stock market is above long-term trends. And so it would seem to me that the balance of risks in terms of continuing to hold stocks or at least not have any short positions is to the downside, because there's very little evidence that we are accelerating out of this pattern of poor economic growth pretty much worldwide that's been going on for actually years. It seems more the case that there are upgrades, downgrades to this or that indicator, and we've seen this repeated, year after year after year. We've had various quarters where GDP growth, even in the United States, has been negative, as has happened in the first quarter of 2015. It would just seem to me that chances are, if you stay invested in the stock market with no hedging, you're probably not going to get much of any return outside of dividends, and you may even experience some losses.
Okay, so you're saying that capital appreciation is not on the current radar screen, as it has not been recently, and that but a portfolio of dividend stocks would be a wise move in the current economic situation. Is that a reasonable summary?
And when you consider what little interest you can earn on fixed income and the risks associated with junk bonds, which have performed horribly in recent months, disastrously actually, then it's the lesser of two evils.
Yeah, actually, one of the indicators is the junk bond industry. So, let's see, and that was where did it go? So at 12/31, it was down to 80 as of the first, down to 80. Yeah, so it's been slipping quite a bit. So what about the current jobs? See, these indicators were as of January 1st or December 31st, and in the interim, the stock market has dropped 1,000 points or so. At least the Dow has, and so with worries about China, are these valid? Is it going to stay down, do you think, or do you think it might come back in the short term?
My guess is it will come back. I think that's in line with a more reasonable level of volatility. We've had such low volatility for so many years that I think investors are unaccustomed to the more normal volatility one would expect, with indicators that are frankly pretty mixed, and with risks outside of the United States that are substantial. Brazil is in free fall, for example. Conditions in much of Europe, while you can point to incremental improvement here and there, are actually disastrous. Unemployment in Spain is over 20%. Unemployment in Greece is over 20%. There's a huge swath of Europe that is effectively in, from an employment perspective, Great Recession conditions, Great Depression conditions.
What about China's the current traders' worry about China? Is it well-founded, or is it really something that really is just a temporary trader's moment?
Well, I think the information I get from a couple of the leading investment banks is that China is a big place, but it doesn't affect the U.S. much. That is the standard line of thinking. The problem with that point of view is that China is far and away the largest importer of many, many commodities, far larger than the United States, a multiple of the United States. It also exports certain types of goods that are a multiple of what the United States does. So in the worldwide context, in terms of its impact on particularly commodities prices, it far outweighs the United States. And to say that that wouldn't impact the United States in some way, given that the United States is a necessary participant in the world economy, is I think naive.
Well, I think the nature of this worry, trader's moment, as I call it here, is because the downgrade of the amount of growth. So instead of growing at 12 or 10%, the figures are now about what, 6.5% predicted growth. So, but that's still growth and not really a decline in economic production. So I think that perhaps it's fairly well. I think it's probably easy to say that this is a temporary down drop in the economy, in the stock market, and is really not indicative of a fairly solid footing economically speaking. What do you think?
Well, I think when valuations are most dramatically affected by deltas, and there are certain deltas, most importantly the slowdown in GDP growth, that have most obviously affected commodities prices. I mean, it doesn't take, if the assumption is that China is going to grow at 10% and they're by far the world's largest importer of copper and numerous other commodities, then suppliers of those commodities plan and invest accordingly. And when that delta decreases significantly, the suppliers are left high and dry with excess capacity. And that's why there's so much turmoil in so many emerging markets. And that will continue, because there's no sign yet that really that China has stabilized. There's still an indication that demand is flattened down, at least for the foreseeable future. Obviously, China will come back at some point. It's too large a place, but this has an impact on real estate prices, where you're seeing real estate in China goes down or sideways when the expectations were that it would increase indefinitely. It has an impact on creditworthiness for those that borrowed on the informal borrowing market in China, which is enormous, as it is in many Asian locations, and now they're left high and dry. And so I think the dislocation financially going on internally in China that we can't really see that closely is significant, and that has an impact on economic growth and economic efficiency and misallocation of capital. And I think there's been substantial misallocation of capital. Production and capacity was overbuilt in China, and that has to be wrung out. And it's painful. It doesn't take a couple of months to do that. It takes sometimes years. So I think the turbulence you're seeing in the Chinese economy is not going to go away in 6 months' time.
Okay, so what kind of influence do you think this will bring to the United States economic situation and to the current stock market situation overall?
Well, I think U.S. equities are overvalued. I think the equity risk premium has risen substantially. I can't put a number on that off the top of my head, but it was excessively low for a long time. But just the fact that volatility has increased measurably necessarily and mathematically means that the equity risk premium has gone up, and therefore share prices should not rise.
Okay, so I take it that you think that there's really going to be a slight downturn in the economic situation of the United States and the stock market in the coming year?
I think it will be a downturn in the stock market. I think we'll end the year lower than we started. Or it could be. I mean, we've had a massive, oh, massive. We've had a significant downturn at the start of the year. I think relative to the end of 2015, we will end up down rather than flat or up. But you may, I mean, honestly, you may make more money in dividends, enough money in dividends that you make up the difference again. And in any case, fixed income poses its own risks, right? Because we have a rising interest rate environment, and we have high yield bonds looking shakier and shakier.
Okay, but what about the presence of the drop and the efficiency that this is going in oil and gas prices are just dropping, and so this is going to bring an efficiency into the marketplace that I would think that would overcome any of these other extraneous worries such as the Chinese market. I think that this is an efficiency coming to the American consumer that will outshine and outperform all other worries. What do you think?
I think airplane stocks will do well and are doing well. I think car sales will do, big car sales, SUV sales are doing well and will do well. I think the oil patch is going to be disastrous, and earnings will continue to decline dramatically, and bankruptcies will go up dramatically. So it's a mixed picture in the United States because we are now the largest oil producer in the world, right?
Yep.
So it's not that simple. It's a mixed picture, and it's going to get a lot worse for the oil patch, unfortunately.
Okay.
And that will affect jobs. That will affect, and there's been excess investment in that sector, and that has to be wrung out. And it's a big business. It's a big part of the American economy.
Okay. Well, go ahead.
And certain states will suffer dramatically.
Yes. Okay. I think, though, the overall efficiency coming into the market from the production and the fracking that has caused the lowering of the oil and gas prices and now hitting the market is going to outweigh, and thus I think overall the stock market will end of the year up. And so I'm going to give you the final word before we sign off on this month's report. Go ahead.
Well, I hope you're right. But at this point, I'm not invested in the public markets. I'm not confident that we're going to get much appreciation. And I would urge investors to make sure at least a portion of their portfolio is hedged to the downside.
Okay. Thanks very much, Rick, and we'll see you next month on the February edition of the Rite Report. And thanks for now.
Thank you.